Okay, we are 1 minute past the hour, so we will kick it off and just want to start by thanking everyone for joining us today. On behalf of Pembroke Private Wealth and Pembroke Management, I'd like to welcome you to another installment of our virtual event series. I'm Andrew Garschagen, a portfolio manager and partner at Pembroke. And today we are excited, very excited to have Jim Furey with us, back by popular demand. I think this is the second or third of these Jim has done for us, to present his latest views on US equity markets with a focus on smaller capitalization companies. So Jim is a founder and managing partner of Furey Research Partners. Jim and his four partners founded FRP in October of 2008, and they provide small cap strategy, economic and macro commentary, and company research to institutional clients. Prior to FRP, Jim was a managing director and head of the Furey Group at Neuberger Berman, a subsidiary of Lehman Brothers, where he managed small cap equity portfolios. Prior to Neuberger, Jim ran small cap strategy at Lehman Brothers and was a member of Lehman's Equity Research Investment Policy Committee. Jim joined Lehman in 2002 and was voted onto the Institutional Investors All-America Research First Team on multiple occasions. Prior to joining Lehman, Jim also ran small cap strategy at JP Morgan and then spent several years managing small cap portfolios at Atlantic Capital and Amarindo. He spent 8 years in equity research at Morgan Stanley and 3 years in corporate finance and Bankers Trust. And somehow in there found time to get an MBA from the Tuck School at Dartmouth, and then started off life with an undergrad in history at Princeton. So Jim, with that, thank you, welcome, and appreciate your time today. So just one quick word on format before I hand it over to Jim. So Jim will walk through his presentation, and then we'll have some time at the end for Q&A. And anyone in the audience can submit questions by clicking. There's a Q&A button sort of at the bottom of your screen, right towards the center. And the questions are just visible to you and to the presenters, but they're not visible to the larger audience. So feel free to ask away. So with that, Jim, I will hand it over to you.
Terrific. Thank you so much, Andrew. The first thing I want to do is say thank you to you and all your partners at Pembroke on behalf of me and my partner, Jeff Burton, who's also joined us today. I so wish that we could be in person. As you alluded to many times, we've been in Montreal and Toronto visiting with you all and your wonderful clients. And I very much look forward to being able to do that again. Maybe we're a little bit closer today than we were a few months ago. So it's going to be terrific. So with that said, let me see if I can share my screen. Andrew, do we have the presentation up?
Yep, looks good.
Terrific. So we will try to spend about 45 minutes going over these slides and then have some Q&A. And one of the things that I think is apparent is it's a very good environment for stocks. And a week ago, we might not have felt that way, particularly with some of the long duration ones, but certainly today it feels that way, and it reminds you of what causes stocks to go up. And it's a combination of liquidity as well as economic growth. And right now we have both. And our core bet is that we will continue to have both. And if the main sticking point is going to be the Federal Reserve tightening financial conditions, I think our headline is they will reduce stimulus, but not necessarily tighten financial conditions, because I think they will lag growth. Now, that's another way of saying that I have a sanguine view and that we think stock prices will go up unless the Fed decides to, either on purpose or by mistake, kill inflation. Because, for example, there are structural and political forces that we'll discuss that is keeping the Fed cautious, not the least of which is the midterm elections, but also includes things like the US government deficit. So with that as a preamble, we do have some slides that our John Galvin puts together that are humorous. And for anyone who would like a copy of our presentation, we're happy to share it. We'll send a copy to Andrew and our friends at Pembroke afterwards. But there's a lot of truth in humor, and we share a little bit of it in these slides. So I'm not going to spend a lot of time on it, but on the humor. But it is true on this one where John looks at inflation. It says we've assembled a team who've seen this type of inflation before. And they're, of course, looking for slide rulers, Matlock on TV, and typewriter ribbons. So these are new times for many people in the markets. We'll start top down, and then we'll get to some small cap specifics. There's nothing more macro than trying to take shape of the entire world. And we see COVID receding, but it is not behind us. And perhaps most importantly, it's not behind policymakers. They do not want to err on the side of being too restrictive or too lenient, and that is guiding policy. We have not transitioned to a period of functional Washington, D.C., and what that means is that the battle to raise living standards, which is what our politicians try to do, will continue on this awkward but consistent path, which is providing extreme monetary policy, but also most recently extreme fiscal policy. And I know there's a significant amount of debate about what the year-over-year comparisons will be in regards to fiscal stimulus, because nothing could be more stimulative than 20 and 21. We'll have more details on that in a minute. But we have already passed two multi-trillion-dollar or over $1 trillion stimulus packages in 21, and there may yet be a third. So with that being said, if our policymakers' focus is on not only the economy, but also, and you hear this from the Fed directly, inequality and equity, the probability of getting tight monetary policy in an election year is not high. And one of the reasons it's also not high is not just political considerations, but also the fact that in every policymaker's back of mind is the demographics and the difficulties we have in generating final demand with stagnant to declining populations in the major industrialized nations, as well as the issues with innovation and leverage. So if we want to go to the conclusion, and then we'll reiterate and back it up, the macro environment is one that is friendly to financial assets. We do have an inflation problem in the near term, but over the longer term, deflation is an issue because of technology, demographics, and the structural issues that we will discuss. And in fact, let's transition to a discussion about inflation. Let's keep it simple, because the more simple, the more likely we are to understand the policy responses and how this plays out. And simply, inflation results, higher prices, when there is more money in demand for goods and services than there are the supply of those things. Well, we have just run through a period where supply was severely restricted as a result of the global pandemic shutting down the economy. And demand, and we'll see this in detail later, went to unprecedented levels when it came to things like retail sales. So of course we would get inflation. When you throw on top of that the problems with the supply chain, it is exacerbated. But just keeping it simple, too much money, too little demand. Now, how does this play out in the economy? We have spoken to you in the past about inflation and the problems with measuring it. We have specifically mentioned hedonic measurements and the substitution of various goods for lower cost ones as they increase in price. There's a group called Shadow Stats, which goes back in time and looks at how inflation used to be calculated, and includes things like house prices as opposed to a survey question of owner's equivalent rent. When you look at the 1980s version of what inflation looks like in the top left-hand chart, you see inflation running almost 15% through November 10th. And that has gotten people's attention. Even the government's published numbers are at 6%. And the reason this matters is because once the public notices, and the Fed therefore has to acknowledge it, the Fed has to fix it or it loses its legitimacy. Now, this is why the market is so nervous. Powell has acknowledged inflation, that it is more than short-term transitory, and so he is making a pledge to be able to take steps to fix it. I've said earlier, and I'll reiterate again, we think they will take steps, but we think they will lag the pace of growth in the economy. So this is also very friendly for earnings. One of the things that continues to recur is that earnings are coming in better than expected. Well, inflation includes the price of goods going up, and there's a lot of operating leverage being put into place, and we're seeing that. That's one of the reasons why stocks have done so well. So will this continue? One of the major points that I want to make is that the key policymakers for the economy, Jay Powell at the Fed and Yellen at the Treasury, both believe in modern monetary theory. They form a powerful team. The intellectual support is from a professor named Stephanie Kelton, who is not the inventor of MMT, but she is the current intellectual force. Just as a brief reminder, those that are unfamiliar with MMT, it believes that the government should run deficits if the government possesses a fiat currency that it can borrow freely and without putting itself into risk. It also believes that you should continue to borrow to spend and stimulate the economy until which time there is inflation, which tells you that you've run out of economic capacity. Modern monetary theory then says the cure to inflation is to reduce government spending and to raise taxes broadly in order to reduce final demand and put back into balance the economy and demand. Well, herein lies a fatal flaw if you're a skeptic of modern monetary theory, and a difficulty if you're a believer, because this has not happened. And in fact, in the current environment, we're clearly experiencing inflation, but we're trying to only raise taxes in the top 1%. And in regards to government spending, we are not reducing government spending. In fact, we are adding trillions of dollars. So if the economy is 23 trillion, we have added 2 programs of $1 trillion already. That's roughly 10% combined GDP this year. And there's talk of another significant add. Obviously, those are over the life of the program. So that math is not perfect, but you get my point. Here's a chart which puts into perspective the pressure on the supply being able to meet demand. Um, Through last year, we actually saw the government spend 36% of GDP as the economy shuts down to keep it running. Frankly, it was a brilliant use of government resources, and it has maintained living standards very, very well. The question is how you deal with it going forward. Before we talk about that in too much detail, let me show you how it's played out in the economy. Let me focus you in the bottom middle slide here, which is retail sales. The gray bars are the individual months, and it goes through October. This chart, it's a little small, but it starts in 2008, and it shows that retail sales largely follow a linear path that climbs with nominal GDP. It also shows that when there's a recession, and here we've got the great financial recession, and then the COVID recession, it typically takes a long time. And in fact, in past recessions, it typically takes over 30 months to regain the prior high in retail sales. Because of the surge in fiscal spending, we saw it took less than 6 months to get to levels above the prior. And you can see that we are now well over 1 standard deviation above trend line. We can also see from the above charts that the deficit has been as high as 160% of government revenues and are currently down to about the 80% range. So what that tells you is that we've been operating under modern monetary theory. It is something that we've been doing, frankly, for a number of years. People are now understanding it. But the question is, how do we deal with inflation?
Jim, can I just jump in there for one quick question?
Sure.
Do you have a sense whether the other countries that have embarked on quantitative easing and stimulative measures like the US, do they have a similar kind of retail sales response like this? Like, are you seeing this in the EU or Japan or?
I do not know the specific numbers, but my sense has not been as dynamic, but it has clearly had the same impact of reducing the difficulties that the pandemic might have created and bringing retail sales back to a level that's healthy. But I don't think anyone's 1 standard deviations above trend as we are. And this is in the US. That's one of the reasons why our currency has been stronger as well. And again, one of the key insights, which I haven't spoken about yet, is that you can't pursue MMT unless you have a fiat currency, meaning it's not backed by any hard assets. And as a result, the dollar, while everyone is commenting on its strength, it's important to note that the printing of so many dollars is leading to its debasement against real assets. So that includes real estate and it includes stocks. So what you're seeing globally as these various industrialized nations pursue MMT, you're seeing their stock markets do well and their real estate markets do well, while inflation is also rising. We're not seeing inflation having a dampening effect, for example, on real estate. It's helping it. Does that answer your question, Andrew?
Yeah, no, that's helpful. And apologies for interrupting there. But
no, please do. So are we going to see secular inflation, meaning it's going to last for a decade? I personally don't believe that's the case, but we are in a period of time where we're seeing the risks of secular inflation increase for several reasons. But to make the point, secular inflation needs to have a recurring catalyst if it's going to occur. One of the areas could be energy costs. And clearly the industrialized world is attempting to go green, and it's trying to move away from fossil fuels. Things like ESG pressures, bankruptcies of so many energy companies, a new focus by managements to return cash flow to shareholders, not just drill, baby, drill, is leading to the potential for energy prices to be higher for longer. One of the things that has occurred is that for 40, 50 years, the cure for higher prices was higher prices because it elicited a supply response. Well, ESG pressures, the bankruptcies, the new mantra, as well as the financial difficulties of Venezuela, Mexico, and Russia to curtail their supply response, is making it so that we are not seeing the supply response. In fact, it was so the inability of the supply response to occur was so worrisome to U.S. political leaders. Biden, for the first time ever, released the Strategic Petroleum Reserve in response to price, not to any macro event. So it tells you implicitly that there is a problem with the supply response to higher prices, and they're trying to create it. In the near term, it has hurt energy prices. They can't release the Strategic Petroleum Reserve forever. So I think energy prices will have an upward bias as a result of all these pressures. And just to put a fine point on this chart, the 5 largest by market cap E&P companies in the US have reduced their capital spending by over 60% over the last 5 years, actually over the last 7 years. The other area that can be recurring is compensation. You're going to see competition for labor. This is a total compensation chart, but hourly wages are also increasing. So the question becomes here, when you look at the JOLTS data, job openings, layoffs, et cetera, the blue line tells the story. Do you think we're going to have a significant wage decline or slowing in the increase if there are over 10 million job openings? My answer is no. By the way, there are only 3 million extra unemployed relative to prior to the pandemic. So one of the questions you're hearing increasingly from economists is, are you willing in your monetary and fiscal policy to create inflation to get 3 million people to work, where you're punishing 330 million in the US who experience a very regressive tax through the form of inflation? And this is one of the reasons why inflation is viewed as so difficult for politicians and central bankers. But let's be clear, consumers get the inflation risk. And in fact, the older you are, the more attuned you are to it because you've seen it in the past. Bond investors do not fear inflation risk like consumers. And in fact, you'll see that this is less than half of the inflation expectation of the older ones. There are a lot of reasons for that, including the influence of the Federal Reserve buying government bonds. But one of the things we can take insight from here, regardless of level, is level compared to the past. And it shows that we have not broken out to new all-time highs. This is because bond investors feel, as I do, that the surge in inflation is going to end. It's a question of in 10 years, absolutely. In 5 years, likely. 1 to 2 years, not so much. let's transition back to MMT for a minute. We made the point earlier that MMT, modern monetary theory, if there's inflation, wants the government to reduce spending or raise taxes. This is a look at the average family of four with median income, half the median income or twice the median income, and their tax rates. It goes through 2014. The point I want you to focus on is the red line. This is the tax rate, the average tax rate for each of these groups. The quick conclusion is that the average family in America has not seen an increase in their tax rate since 1979. And the Biden administration has just said they're only going to raise taxes on the top 1%. So this is a reason inflation could continue if the fiscal spend continues. In fact, the only realistic alternative to slowing growth is higher rates. This is a look at debt service. The green and blue lines are consumer debt service as a percent of their income. And you can see how stimulative interest rates have been, because this chart goes back to 1980. We are at multi-decade lows. We've transferred the debt service burden to the government. And in fact, this is where the risk lies. The government's debt burden is higher as a percent of GDP than it has been in the past. And it's why the belief in modern monetary theory is so important. And as is true, we so far haven't seen the impact on interest rates or the dollar, again, because the dollar competes against other fiat currencies. But clearly, this is a risk, because you can't raise rates undeniably, because currently debt service is an important percentage of the government budget, but it would quickly get out of control. In fact, let's detail that. If you look at the nominal spend on debt service, it's currently about $520 billion. The average duration of the government debt is 5 years, and the interest rate on that is 1.25%. So you can see if rates went up to 3.25 or 3.5, what it would do. As a percent of GDP, it's only 2%. We could easily double it without going to extreme. So there is room.
Actually, Jim, can I jump in with one more question on that last slide? So I've heard this argument before that well, yes, the debt service burden in an absolute term is pretty substantial, that the percent of debt that's actually held by the US Treasury is also pretty substantial. I mean, so like, because these quantitative easing programs to keep interest rates low, mechanically, the Fed has pursued those by buying treasury bills and mortgage-backed securities. I mean, so in essence, when the government's paying back or paying coupons, it's going from one pocket into the other. So what's your take on that argument? Because I think in Japan, that's often pointed to as why interest rates are sort of, I guess, are less feared, because something like the Japanese Treasury owns 60% of their outstanding debt. So just curious what you think about that argument.
This is what is operating. It is absolutely working. It will continue to work. The question becomes how much money the fiscal side spends and whether or not it creates inflation or not, and the role that the central bank plays in financing that growth. Currently, with a modestly reduced quantitative easing, but still at over $1 trillion a year, it's a substantial aid to inflation. But your point is very well taken, and quantitative easing is the way that the Fed monetizes the debt or purchases it, because the government, the Federal Reserve Charter doesn't allow the government to directly issue its currency. They have to sell bonds to the open market and then to raise capital. The Fed is, in essence, buying a large percentage of those bonds, over 30%, in order to finance it. One of the reasons the Fed is reluctant to reduce its quantitative easing is because it knows it has to keep that source of demand for government paper coming. So this is the crux of the issue, and I anticipate the Fed will continue to be a buyer of substantial amounts of the deficit that occurs. I see we're running a little bit behind, so what I'm going to try to do is move a little quicker. But I would point you to the US dollar as one of the key Fed indicators of whether its policies are working. And the dollar has been strong, and this makes the Fed confident. But again, if you focus on this exclusively, you miss the fact that the dollar printing is causing debasement against real assets. So why hasn't the Fed hiked, given everything that I'm saying? Well, the pandemic is clear. It's still going. We've had the recent worry. The global economy is highly financialized. There's a lot of leverage, and the wealth impact of if hiking goes too far and destabilizes the stock market, then that is going to hurt growth. And we've already spoken about the demographics and technology deflation in the past. So we've made this point to you in the past, but it remains the same. One of the reasons the Fed hasn't hiked is the government is dependent upon tax receipts in order to fund all of its promised social safety nets. And this is in Japan, the US, and Europe. But also they're hesitant to hike because they don't want to damage the savings of the retirees. This is the chart which we've talked about in the past, where the economy, the global industrialized economies, are not growing. As people age, they spend less. The US is aging, and this is another reason in the background. Fewer workers. Let's stop here for a minute on page 29. This is the margin debt versus the market cap of the US. You can see there's almost a linear relationship, a correlation of 1. You can also see the current trend up. The higher interest rates are, the less attractive debt is. They do not want to crater the stock market by forcing a large margin call. What they would like to do is see margin debt go sideways, and it's it is not an easy dance to dance. But this is one of the reasons why they've also been hesitant to hike. Let's transition to a minute why inflation matters to investors. Basically, it isn't so much about nominal returns, because inflation is friendly to earnings, and it's friendly to inflation keeping stock prices up until the moment that the Fed decides to kill it. Now, they can raise rates without trying to kill it if they lag the growth in the economy as well as inflation. But pragmatically, it matters for asset allocation. Do you want to be in growth, or do you want to be in value? Do you want to be in cyclicals, or do you want to be in secular growth? And anyone who has owned the longest duration assets since January 1st of this year has felt the pain of why inflation matters, because inflation has boosted the relative earnings growth of the cyclical side of the economy and damaged the multiple of the high growth area. let's look for a minute here on page 33 at exactly what has happened to the highest multiple kind of slowdown companies. This is what we call a high profile stock index. We've got the charts listed here. And you can see that at the beginning of this year, and this is a logarithmic chart. If it had been arithmetic, it would have been off the charts. An index of this has climbed from, fallen from 800 to about 350. The relative performance has been similar, and the average decline has been over 60%. If inflation disappears, there will not be the multiple compression. One of the things that always occurs is that investors rotate to where there's relative earning strength and pricing power. So as you look at companies, you look at industries and sectors, you want to see where gross margins are the best and earnings are the best. And again, inflation impacts where that will reside. So the inflation summary, because it's so important. There are reflexive forces at work in energy and wages that can drive a sustained inflationary cycle. We don't know how long it's going to last. It's occurring now. But the Fed is trapped, and we don't think they're going to get ahead of the curve, particularly if monetary policy operates with a 9-month lag. You look forward, they haven't really started to tighten, and you've got the midterm election. And again, inflation is not bearish for stocks until they start to try to kill it. So where are the markets? One of the things that's confusing a lot of people is the shape of the yield curve and the level of nominal rates. We've made the point that inflation expectations are a function of the duration of your view. If you're looking out a year, you expect inflation. If you look out 10 years, you don't, and everything in between. Our John Galvin has created a chart that looks at, through TIPS, Treasury and inflation protected securities, what the inflation expectations in the market are through the various maturities. And you can see that the yield curve is very positively sloped. And if you look at the yield curve, the 10-2 curve, it's actually in the orange, which is the real level, been accelerating, which is a sign of positive economic growth and earnings. The nominal chart has been going down. The nominal chart has been declining because inflation expectations in the further years has been, in fact, declining. So when you look at the nominal curve here, the top box is the yield curve. It has been falling. And in fact, you see the yield here in the 10-year in green at 1.45% falling and the 2-year rising. Under normal circumstances, which would have inflation expectations be evenly distributed over 10 or 20 years, this would lead one to conclude that you were seeing a declining growth economy. But because of the dynamic with inflation, the chart to look at is the orange one, which shows that real interest rates are actually increasing, which is bullish for growth. So very subtle point, but very important. Why does it matter to small caps? When real rates rise, small caps do very well. When they fall, not so much. And when small caps rise, they outperform, when real interest rates rise, they also outperform large historically. Small caps, up until 2 days ago, this was as of Friday's close, were very worried about the pace of the Fed taper and the Omicron variant damaging growth. Technically, we went right to the uptrend's lower edge, And as you can see, we're bouncing. Technically, that was an important test. It passed. When we back here, we had a failed breakout, excuse me, and we're now looking like we may break out again. We think there's roughly 30% upside when looking at the various technical ways to be able to look at price targets. This is the point and figure, and this is a Fibonacci number. The conclusion, there's plenty of upside. The market on a sector and industry level is led by cyclicals, energy, tech, and industrials. This chart shows what's to the right is under accumulation and what's to the top is outperforming. If the economy wasn't doing well, technology, industrials, and financials wouldn't be on the right-hand side and energy wouldn't be on the top. If investors thought we were going to see a significant decline in growth, we'd see utilities and staples leading. Small caps have outperformed mightily off the COVID bottom. They've lagged since the beginning of the year, roughly a 50% retracement, typical technically, and now we're hopeful that small can again outperform. Small cap cycles tend to last for an extended period. Most recently, small has been lagging for 9 years. We're currently seeing a retest of whether or not small can keep that COVID leadership going. What this chart shows is that small tends to outperform when interest rates are rising, inflation is moving higher, and cyclicals do well. Those are the things we could see. Are small caps inexpensive compared to their past history? If the earnings come through that are anticipated, small caps will be selling a year from now 1 standard deviation below their historic range. That is unlikely, which means there should be gains. Earnings, 2021 earnings have been moving up all year. That's unusual. Small cap earnings typically start the year high and fall. Similarly, 22 earnings have been going sideways and are just starting to move higher. Should these break out to new highs, it would be consistent with small caps breaking out. I made the point that small caps typically have negative earnings revisions over the course of a year. This goes back to '99. You can see that 2021 is the first year we've had positive revisions. The good years, typically coming out of recession, see them being flat. So we talk about inflation and nominal growth helping earnings. This is part of the evidence. Small cap earnings should be growing more rapidly than large, but there's risk to this forecast. Why? Look at in the bottom left, large cap margins. They're approaching 12%. Small cap is roughly 5%. They're at high levels. But when you look at the productivity of a marginal dollar of revenue, one new dollar of revenue, it hits the bottom line more productively in large caps. And this is one of the reasons that small has struggled to beat large over the last number of years. And you can see the margin degradation. But in a strong economy, that may not be the case. Growth is a little bit more expensive than large. It's one of the reasons why, as inflation expectations have risen and earnings have grown, growth has started to lag a little bit. And the most expensive of the small cap growth stocks have done poorly. Now, one of the interesting things is this paints a very positive picture for institutional small cap relative performance, because they typically do not own the most speculative, expensive stocks. And in fact, we've seen a surge where the average institutional small cap growth manager has handily beaten the indices, and that clearly includes Pembroke. Now, there are risks. The Fed, by mistake or on purpose, could tighten too much, and that would reduce liquidity, which could take stocks down. We clearly have market structure issues around passive investing and risk parity, that if the Fed does do what I don't think it means to do, which is to tighten so fast that it creates a recession, you could have a correction. Also, the Fed may be forced to, because the economy may just have no give up. Also, the economy is slowing from very high rates. Stocks do not like the second derivative of growth slowing because they worry when it will end. Offsetting this, however, is the positive earnings revisions that I've just showed you, plus the prospect of the stimulus that we've had passed, may pass, and the Fed being behind the curve. Remember, stocks are a nominal game, not a real game. Real wages have been higher. They've been growing nicely. Real wages, because inflation has been high, have been negative. This is why consumer sentiment has been so difficult and why the politicians are getting so much heat. I should also say negative wages and inflation creates what would be a traditional economic cycle. Joe Ellis, the old Goldman Sachs analyst, wrote a book on this, and it's something that it's been so long since we've had inflation, you forget. But when inflation surges, it makes people unable to buy the same unit volume of goods or services. When that occurs, there's a buildup in inventory. That buildup in inventory eventually leads to a reduction in production, which is a recession, at which point the whole process reverses. Why do I make that point? Recession is unlikely in the current environment when we're still trying to rebuild our inventory stocks that were drawn down as a result of a global decline in production as a result of the pandemic. Energy prices are a risk. This currently has fallen back below the line. I kept it like this to show that there's been a powerful uptrend, and technically, if we break out again, that's going to create a risk. Inflation, I said, has had a negative impact on consumer sentiment. The University of Michigan's consumer sentiment is something that correlates with a positive correlation of just about 1 to the Russell. You can see that we're making new lows. This has only occurred once before in 04 and 05 when the Russell did not decline. What it did was it led to later declines. So this is a risk. What's causing it? Media, social media, inflation, political dysfunction, worries about China, all of the above. We've really touched on this, but just to put an exclamation point on it, labor force participation is down. There's been the Great Resignation, and it's leading as globalization potentially reverses because of geopolitical issues and supply chain concerns. It could lead to inflation, which could force the Fed's hand. So I know I've gone over by 5 minutes the prepared remarks, but I would love to be able to take any questions.
Well, that was great. No, I mean, it's lots of thought-provoking and interesting content. So just to remind people, there's a Q&A button in the bottom sort of center, a little bit left of center part of the screen. Feel free to click on that and ask a question. And as we see them come through, we will start asking them. But in the meantime, actually, I've gotten a few emailed to me. So I'll just start when there's a bunch. So you can maybe go through a little bit of a rapid fire on some of them. But first is, has MMT ever had an inflationary test before?
Yes, in emerging markets and banana republics.
Okay. But not in a fiat currency, not in a sort of an economic landscape like that the US would be going through, for instance.
So that is somewhat of a flippant remark that I made, but there's truth in it. But I would also comment that Japan has also been pursuing for over 20 years MMT. It has never had a inflation test. So I'd have to answer to that no. And this is one of the main reasons why people think that we may actually have a broader secular inflation.
Yeah, okay. And has inflation started to impact US consumer balance sheets yet? I mean, I think you had a chart in there about, how much money has been transferred to the consumer. The consumer, we see this in many respects, is very healthy. The home price has gone up dramatically, which has increased the wealth effect. But so has inflation actually started to impact the consumer? Or is it more, that people are being told to worry about it versus they're feeling it?
I think it depends where you are on the socioeconomic scale. So if you are in the top quartile, you likely own stocks, you likely own your house, and you are likely a knowledge or skill-based worker, which has bargaining power versus your employer. So you have benefited and your wage and wealth has increased at a more rapid rate. The bottom half of workers experienced a unprecedented surge in their wealth and savings during the pandemic. Their unemployment and social payments actually, in many cases, were above their prior level. So we saw savings actually surge in the US, and it's led to the surge in retail sales. That continued surge in retail sales leads one to believe that inflation is neither negatively impacting their purchasing power or having drawn down their savings in real terms. So the inflation that's impacting the consumer sentiment, I think, can be said to be forward-looking, and we have yet to see the negative impacts. We will see it when GDP starts to slow. Right now, I think we're borrowing off of all of the wealth gains and the money that's been sent out. The child tax credit, which is $300 per child per month, is massively important. If you were on unemployment, your unemployment was roughly, call it $300 a week. And now you're getting $300 per month per child. If you're back at work, it can have a big impact. So I'm not sure that answers your question, but
yeah. I mean, well, and to that last point, like, is there an expectation that the Great Resignation, as you had the chart sort of showing the participation rate falling off, is there an expectation that that could revert, in the coming years when people burn through these savings and the consumer is in less healthy a position, or is there a belief that it's permanent?
I don't look for a major increase in the participation rate. One, it's a very powerful trend, and that means there are forces at work that are likely unchanging. Secondly, I think COVID has changed our life-work balance in important ways. And while there clearly are cyclical factors around women that have to stay home for child rearing or husbands. I mean, that happens too. I don't mean to be sexist. But the life-work balance is different than it was pre-COVID, I think, because we've had a massive experiment with what life would be like if one of the workers did not work in a nuclear family. So as a result, I do not expect there to be a major reversal in that trend. And maybe that changes if there's a massive, an important change in the demographics of the population of working age people. But as one of the charts showed that I went over briefly, the number of working age populations actually declining, and it's not forecast to go up for at least the next decade. So as a result, your labor force participation won't get a mix shift to having more younger workers come in. That's important.
Yeah, well, and there was actually one question came in about demographics, and you've, as you referenced, you've talked about that more extensively in previous calls we've had. But you know, I guess much has been made of the Chinese government programs in the last year or two to try to encourage childbirth and reverse the trend. I saw a statistic that said that under some forecasts that by the end of this century, China could go from a population of 1.3, 1.4 billion down to 700 million. So it's difficult to grow your economy when you're growing that fast, or when you're shrinking that fast. But the question was just on U.S. demographics was, so do you expect the U.S. to take any steps to confront the demographic or population challenges?
Well, we have, in that we've tried to encourage immigration. But it has not been the encouragement that we've seen in the past. We still have net positive immigration. And I just want to put an exclamation point on this demographic issue. China ended their one-child policy a number of years ago. And during the pandemic, their total fertility rate in 2020 fell to 1.1. You need a total fertility rate of 2.05 or 2.1 to be able to maintain your population. There are multiple and complicated reasons that the industrialized world is seeing fewer children. It includes women wanting to work, children living with a higher probability, higher quality of life because of education and children are expensive. So these are things that are not easily fixed. Elon Musk did a very high profile interview yesterday with the Wall Street Journal, and I encourage everyone to listen to it. But one of the points he made that may go unnoticed relative to some of his other ones is he made the point that the demographic challenge that the United States or the globe faces is the number one threat to growth and political stability in the world. And it's getting worse, not better.
Yeah. Well, I mean, it's like all these sort of cross currents that, I mean, it's demographics, but it affects inflation, as you were referencing, and economic growth. I mean, it's a really tricky setup at the moment, that there are some very clear factors in the near term that are driving inflation, and that's certainly captivated the media and the financial press, and seemingly kind of influenced the Fed chair Powell. I mean, so one other question came in, sort of a short one. It was, how political is the Fed? And I was thinking about it in the context of Powell last week, quote unquote, retiring the term transitory from his discussion of inflation, when I'd seen a presentation I think he gave at the Montana, what's it called? The Fed conference, the central bank.
Yes, Jackson Hole.
Jackson Hole, thank you, Wyoming. So he gave he sort of doubled down on his longer term disinflationary thesis just 2-3 months ago, with demographics, technology disruption, driving productivity, and a couple of other points. But then, so back to the topic of how political is the Fed. what do you make of that? Do you have an opinion on that? And I guess probably what the question was getting at was there something political about retiring the use of the word transitory in describing inflation, or is there something else at play that actually Powell has meaningfully changed his opinion?
So this is so important. Let me start by saying that the Fed, as the world's most important economic body and largest central bank, has an impossible task. It is very difficult. Let me also say, I think they're very well intentioned. They're also very smart, and they want to have the highest standard of living for the most people. And increasingly, because they recognize that the global economy is dependent upon the US dollar for things like settling trade, that there are unintended consequences of their actions that are often bearish. For example, if they start to tighten financial conditions and reduce the dollars available, that slows global growth because the price of the dollar goes up. And if 90% of global trade is settled in dollars, it gets more expensive to settle trade. So they also recognize that the federal budget deficit and the social welfare programs that are currently in place are very important to social stability and our living standards. And so they operate with a desire to maintain tax receipts at a high level to avoid recessions. And particularly during times of stress, they understand that they need to underwrite the spending. So towards this end, it's really interesting that in the first months of the pandemic in 2020, as there was a surge in demand for US dollars and paper, and there was a real risk that the interest rates would turn negative and the dollar would soar, the Fed actually borrowed over $1.2 trillion more than they were actually spending for all of their emergency programs. This built up a huge balance on of the Treasury at the Fed that over the course of this summer, they drew down. Why do I bring this up? Well, they understand their role and how it ripples throughout the economy, and they don't want to go to negative interest rates, and they don't want to create recessions. So I have answered indirectly, and now I'll answer directly. The Fed is totally political because it views itself as the leading economic actor in a world where there's except in crisis, political dysfunction, and it's trying to keep the boat afloat. It's very difficult. So my comments earlier about their stance is a gaming of that system, as every major investor in the world is doing. Every investor is gaming it just like I am. If I am wrong on that question, financial markets are going to have a difficult time.
Yeah. Well, and it's at moments like this where you're in these transitionary periods where, an old regime is maybe transitioning to a new one, where an economic cycle is going from early to mid or mid to late, where there's lots of uncertainty, and you can read situations in sort of opposite sides of the coin. And then when you add a layer of politics to it, when you're trying to sort of analyze what's going on with the Fed, it just can make it that much more complex.
You have reminded me of another point I meant to make, which is the Fed has long held that their words are as important as their actions. And so they are trying to jawbone an expectation that they will fight inflation effectively, and that will reduce inflation expectations. And that's as important as their actions. Just like when they said they would buy corporate paper during the pandemic. They actually bought very little paper in the single billions of dollars. But the expectation that the Fed would act created a self-fulfilling market phenomenon. So it is also not, it's very beneficial when Powell retired the word temporary, transitory last week. 10-year and 20-year inflation break-evens fell over 30 basis points. The market said, you're going to do it. So again, this is very positive because I don't think they will be.
Yeah. Yeah. Well, and we talked about this offline too. And then when you see that with the yield curve, with the kind of 10-2 yield curve and the yield curve flattening, I heard an interesting argument that said that the reason that happened, which is a flatter yield curve, and then if it goes towards an inverted yield curve, is a sign that the market thinks we're heading towards a recession or some sort of economic contraction. But I heard an argument that was that move in the yield curve after Powell's sort of comments on the retiring transitory was a sign that the market thinks that he's going to bumble it, or whatever, mismanage it. He's going to hike too fast and send the market into recession. So I don't know if you have any thoughts. I mean,
I tried to cover this, but clearly I may have missed the mark. The reason we put that chart of the real yield curve is because the Fed actually cares about real rates more than it does nominal rates. And what we've seen, and I'll share my screen again. See if I do this. Are we seeing the presentation?
Yes.
If I knew what page it was,
Here it is. That one.
In this bottom right, the orange curve is real rates, the 10-year minus 2-year. The blue curve is nominal. This is the expectation that we're going to see strong economic growth. The upper left is the actual level of rates. And you can see that they are negative or highly stimulative. They're not even close to real rates being positive until you get out to 30 years. And that's using a relatively benign inflation calculation. If you used a trailing 12-month, and John Galvin created these charts, if you used a 5%, well, it's the real yield curve. If you assume that inflation would be 5% for 30 years, these numbers would be even more negative and closer to where we are right here. Does that make sense?
Yeah, no, it does. I mean, and I guess a couple of takeaways for, just equity investors and particularly smaller company and growth stock investors is that, near term, you've got an economy that is still strong and has got sort of a strong nominal, the nominal curve was pointing to there being healthy growth in the near term. But then over the long term, the rates are still look to be relatively low, sort of that lower for longer dynamic appears to still be in play, which, generally, I guess over the short term would be good for small caps, and then for over the long term would be good for growth stocks.
Well, there's an expectation, my partner Jeff Burton likes to call it the 2-2-2 economy, 2% growth, 2% inflation, and 2% 10-year yields. We've never seen the attempt to pursue modern monetary theory in a time of inflation. And we've never seen two programs pass like we have, and the potential for a third following the pandemic. We don't know how this is going to play out. The child tax care credit is very high velocity money. As soon as that check goes into the checking account of the average American, it gets spent. That is due to expire in a year and a half. If it stays on, that's going to have a material impact. it's going to be a very interesting couple of years. But if what you're thinking about as a stock investor is, will the Fed end the party? I would say not intentionally. Is there an alternative that is attractive? I wouldn't say in the bond market is attractive relative to stocks. And is there an opportunity for exciting growth on an individual stock level? I would say absolutely. And that points to what I hope will be, if we return to more normal times, what we've seen since in the last year, which is active management does much better than the indices, because things like inflation damage the most speculative of stocks and hurt some of the industries that have been powering big gains. There is no question that we are in the era of healthcare, in particular of biotechnology, but they're long duration assets, and not everyone is going to be a winner. But active management allows you to be able to find those winners and punish, if you have rising inflation, those that have not done well. It's one of the reasons why biotechnology has been so difficult subsequent to the COVID bottom, as inflation started to increase.
Yeah. Well, Jim, we've gone 10, 12 minutes beyond. I kind of let the Q&A run away, but there are lots of good questions that came in, and a few that we aren't going to have time to get to, but we'll be sure to write back to the senders and sort of come back with some thoughts. But just want to thank you so much for your time. I mean, obviously, as we've said and you've said, these are sort of tricky moments, and there's a lot of stuff going on at the macro level. I mean, that's one of the reasons why Pembroke, as multi-year growth stock investors, why we focus on, one, the long term, and then we focus on the bottom up fundamentals, because it's our skill set is not kind of parsing out the macro and analyzing and understanding those dynamics as you do. We sort of stick to what we've been good at for over 50 years, which is finding exciting sort of entrepreneurial, well-aligned companies that are going after enormous market opportunities with sustainable competitive advantages and can kind of grow largely irrespective of the cycle that they're in. So, but it's great to kind of hear your perspective. And I know, given the attendance that we've had today and the engagement, people have stayed on over the hour, so that was good to see. Our clients love it too. So thank you again for your time and insights, and we look forward to continuing to work with you over the years and bringing you in front of our clients again sometime in the future.
Well, thank you, Andrew. Jeff and I both hope we can do it in person when it's next appropriate. So we always love visiting with you guys. So
great. Look forward to it.
Thank you, and Happy New Year a little early.
Yes, you too.
Thank you, guys.